Right now, gold is trapped in a critical technical no man's land. The spot price is sitting just above its 200-day moving average of $4,340 an ounce, firmly capped beneath its 50-day moving average of $4,730 an ounce. Something has to give, and when it does, most people watching this chart will already be too late. In the next 10 minutes, you're going to learn 3 things. First, why this boring gold consolidation is hiding a massive structural shift in the global financial system. Second, the actual mathematical reason your paper assets are quietly losing value every single year, whether you feel it day to day or not. And third, why silver just broke a resistance level it hadn't touched in over a decade, and what that shift could mean for the years ahead. Stick around, because the connection between these 3 things is not something you'll see explained on mainstream financial television. To the average retail trader tracking the flat lines of a slideshow chart, gold's sideways action looks like nothing more than a boring consolidation phase. But behind that apparent stall sits a massive structural shift. While paper markets obsess over short-term corrections down to the recent floor of $4,170, a quiet migration is taking place in the global financial underground. According to recent over-the-counter and Swiss refinery trade flows, central banks are quietly bypassing traditional exchanges to accumulate physical bullion at historic rates. China's net imports alone inflected sharply higher, surging nearly threefold quarter-over-quarter to 317 tons. The question isn't whether explosive macro demand for gold will return. The question is how much wealth you stand to lose before the traditional financial system breaks under its own weight. This isn't the first time in modern history that quiet institutional buying has shown up long before retail traders noticed anything on a chart. It rarely announces itself with a headline. It shows up first in trade flow data, refinery output, and vault inventories, months before it ever shows up in the price on your phone. Here's the part almost nobody talks about on financial television. The foundational driver of this entire precious metals thesis isn't fear, it's mathematics. The United States is locked into an accelerating debt spiral, driven by fiscal policies that leave the Federal Reserve with 0 elegant exits. Every year, government spending vastly outpaces real tax revenue, forcing the issuance of trillions in new treasuries. That creates a compounding cycle of currency debasement. When sovereign debt expands faster than economic output, the underlying currency has to lose purchasing power. Think of the store owner quietly watching his register every night, or the worker counting out bills that buy a little less each month than they did the year before. There are really only a handful of ways a government can handle a debt load this large. Grow the economy faster than the debt, which requires a level of productivity growth most forecasts don't show. Raise taxes enough to close the gap, which carries its own economic and political cost. Default outright, which no modern government wants its name attached to. Or quietly inflate the debt away by letting the currency lose value over time. History suggests which option gets chosen more often than the others. For decades, investors leaned on government bonds and ETFs to preserve capital, but when real yields trend lower and inflation stays stubbornly persistent, those paper assets stop protecting you. They start quietly destroying your wealth instead. And this is the part that's easy to miss if you only look at nominal numbers on a statement. A dollar amount can go up on paper, while what that money actually buys you goes down at the same time. That gap between the number on the screen and the real purchasing power behind it is exactly where currency debasement does its quiet damage, year after year, statement after statement. Now, here's where most analysts get the picture backwards. Non-OPEC supply growth is pushing crude oil benchmarks like West Texas Intermediate into a structural downtrend toward the $60 range. On the surface, that looks like relief. Lower prices at the pump, lower headline inflation. But that relief is an illusion. Lower energy costs here reflect an industrial slowdown, not a healthy currency. And this creates a massive divergence. Wall Street analysts warn that if the Federal Reserve is forced into a hiking cycle to fight structural inflation, gold could face temporary headwinds from Western ETF outflows. But that analysis misses the bigger picture entirely. When global confidence in fiat currency erodes, the paper markets stop mattering. The physical reality takes over. Most retail traders are still fighting the last war. They're watching interest rate decisions, and ETF flow reports like those are the whole story. But central banks aren't buying bullion because of this quarter's rate decision. They're buying because they're planning for what the system looks like 10 and 20 years out, long after any single hiking cycle is forgotten. This brings us to the real battleground, physical gold and silver, and they are not playing the same game anymore. As macro analysts who track this space frequently point out, investors keep asking the wrong question when they focus purely on what price gold will hit next. The real question is, how much do you stand to lose by holding paper currency instead? Gold remains the ultimate long-term baseline for wealth preservation, but silver is stepping into a completely unique story of its own. After spending more than 13 years trapped below a $54 ceiling, silver recently shattered that multi-year resistance, entering true price discovery territory for the first time in a generation. It is no longer just gold's volatile shadow. That breakout alone should have gotten more attention than it did. A resistance level that held for over a decade doesn't break on noise. It breaks because the underlying supply and demand picture has fundamentally changed. So why is silver suddenly breaking free? Because three powerful forces are converging at exactly the same time. First, silver is facing its fifth consecutive year of structural supply deficits, with above-ground stocks thinning out rapidly. Second, mine production simply cannot ramp up fast enough to meet demand before the late 2020s. And third, industrial demand is steepening exponentially. The massive electrical loads of AI data centers, next-generation 5G networks, and high-efficiency semiconductors all require silver, and there is no viable substitute. Every attempt to replace it results in inferior performance. When you combine an unyielding industrial demand curve with a severe supply deficit and macro currency debasement on top of it, the setup becomes highly asymmetric. You have a metal the modern economy cannot function without, running low on above-ground supply at the exact moment more capital is looking for somewhere to hide from a weakening currency. That is not a coincidence. That is a setup years in the making. So here's the final verdict. The short-term price fluctuations you see on a digital chart are noise. They're trailing indicators of a legacy system trying to maintain its own equilibrium. Staying fully exposed to paper assets, traditional bank deposits, and unbacked fiat currency is a high-risk strategy in an era of structural debasement. None of this means the price goes in a straight line. There will be pullbacks. There will be weeks where the chart looks like it's proving the skeptics right. That's exactly when the loudest voices tend to shake people out right before the next leg of the underlying trend continues. The play here is to look past the temporary corrections and to use periods of consolidation to build a firm foundation in physical gold and silver. Take control of your capital, anchor it to assets that cannot be printed, debased, or defaulted on, and you put yourself in a position of real financial security. This is one framework for reading the macro picture, not financial advice, and markets can stay irrational longer than any chart predicts. So always do your own research before you act on any of it. If this breakdown of the debt spiral and the metals breakout made things click for you, the video on your screen right now goes even deeper into how this cycle historically plays out. Hit subscribe if you want the next part of this series the moment it drops.